Welcome everyone, it's That Money Guy, and today we're going to be talking about Trump and his tax cuts and see how it affects everything, if it was good, if it was bad.
So to begin, let's see if you even have to file taxes in the first place. So from Pocket Sense, we have this. What is the minimum reportable interest on a tax return? By Mark Keenan. So if you scroll down to the 2018 minimum filing thresholds, you'll see that if you're single, your threshold is $12,000. If you're the head of household, it's $18,000, and if you're married, it's $24,000. So if you make less than that, you don't need to file your taxes. So from the first episode I had about high interest bank accounts, we have this example. If you're single and you have $500 of interest and $5,000 of other income, your total income is $5,500. So you don't need to file your income taxes. Even if you do not need to file your taxes, you might still want to in cases where the federal government or state government took out more tax than they should have. So for me, I did an internship in Iowa, and the federal government in Iowa took out more taxes than they should have, but I made less than $12,000. So I got an extra $500 back because they shouldn't have taken that out of my paycheck. Now, let's talk about those tax revisions. Here, from the balance, we have how Trump's tax plan and how it affects you. So, scrolling down, you can see the income tax brackets. Everything changed on January 1st, 2018 onward to 2025. So, if you're single and you made, let's say, $100,000, the first $9,525 is taxed 10%, and then the income that you made between $9,525 and $38,700 will be taxed 12%, and then the income between $38,700 and $82,500 will be taxed 22%, and the remainder will be taxed 24%. And that's just the U.S. graduated income tax bracket system that we have. And the individual income tax deductions and exemptions. So your standard deduction will be double. So in 2017 it was $6,350, and in 2018 it increased to $12,000. So you can deduct that from your taxable income, which helps everyone. Just remember that all of these tax brackets and exemptions and everything are adjusted for inflation. So as inflation increases, the tax rate will also increase, which was under the 2017 system as well. Just a little reminder. And it eliminates personal exemptions. So for each dependent that you have, so someone that you provide for more than half of their income, you can no longer deduct that part from your income. So you can no longer deduct $4,150 from your income. So that kind of sucks. It eliminates most itemized deductions. So this one's really interesting. If you're paying alimony, you can no longer deduct it while those receiving it can. So that changed a lot of divorce agreements. And then if you look at your retirement savings and student loan interest, if you're over 70 and a half, you can now donate up to $100,000 to charity, and it won't be part of your income tax. And if you look at the deduction on mortgage and interest, it's now only $750,000 of the loan. So before it was $1 million you could deduct, but now you can only deduct $750,000. You can no longer deduct state and local taxes. Well, you can, but only up to $10,000. So that hurts high tax states like New York and California. And those are the medical expenses. Now it's only 7.5% you can deduct. Before it was just 10%. And if you have an estate tax, this helps you because it doubles the estate tax exemption. So if you inherit property, now you get taxed less of it. It increased the child tax credit from $1,000 to $2,000. So for each child you have under 17, you can claim $2,000. Oh, by the way, just to clarify, there's a difference between a tax deduction versus a tax credit. So Regarding tax deduction versus tax credit, the essential difference between them is that a credit decreases the amount of tax you owe, while a deduction lowers your overall amount of taxable income. So if you're in the 25% tax bracket, a $1,000 deduction lowers your taxes by $250. A $1,000 credit lowers the bill by the full $1,000. So you always want a credit. Credits will beat deductions all day long. Now, going back, we can see that the Trump tax cut repealed the Obamacare tax. So if you don't have health insurance, you no longer get taxed for not having it. And the business tax rate, so the maximum corporate tax rate on businesses, is now 21%, which is more in line with the international average. So before it was 35%, now it's 21%. And if you have a small business, so like a sole proprietorship, now you can now deduct 20% of your income, rather before you couldn't deduct any. Oh, and environmentally related, the Tax Act now allows oil drilling in the Arctic National Wildlife Refuge, but that wouldn't be profitable until oil prices reach $70 a barrel. So the Tax Act helped the high income earners the most. So the top 5% would earn 2.2%. The 20 to 80% range, the middle class people, would receive a 1.7% increase, and the bottom 20% only received a 0.4% increase. And because of changes to the estate tax, for example, people who inherit wealth will now benefit a lot more. There's fewer deductions, which saves time on your taxes, but might hurt you. If your itemized deductions are less than the new standard deduction, you win. Large families, you may be hurt by the elimination of personal exemptions, so you can't claim dependents of your grandparents or your children anymore. Homeowners have a reduced benefit now because they can only deduct $750,000 instead of $1 million. Young people no longer have to pay that Obamacare tax, and the self-employed now qualify for a 20% deduction on qualified income. So this tax bill definitely helps businesses more than individuals. In conclusion, the Tax Act may curtail economic growth in the long run. According to the Joint Committee on Taxation, the act will add $1 trillion to the debt over the next 10 years. Since tax rates weren't prohibitive because we were in a peak of economic growth where we were expanding and the economy was good, it won't create too many jobs. So this might hurt future generations that might need to increase tax rates to pay down the debt. If you want to file your taxes, you can go to taxact.com. It's free for most people. You can also go to the IRS free filing, just Google that, and you can look for the free file tab, and boom. If you make less than $66,000, the IRS has a little tool to help you there. And a lot of the changes I spoke of are only temporary. Some are permanent. For example, the 21% new corporate tax is a permanent change, while the reduced federal income tax rates end at 2025. So most of these tax amendments will end at 2025 unless Congress renews the tax cuts. But the business cut will stay intact no matter what, unless Congress changes that too. So, I hope that was helpful. The sources I used are below. Please subscribe here and watch my first ever episode all about those high interest bank accounts from 2 to 6.17% interest. And here you'll see my next episode all about the self-employment tax and how to get the most out of your Social Security benefits, because you want that money.